If capital sets appetite, models set the menu. So let's open the kitchen. Picture a clean interface on a second monitor. WAR RMS or AIR worldwide. Left side inputs. Hazard, exposure, vulnerability, replacement cost. Right side outputs. Annual average loss. 1 win 100 and 1 win 250 tails. Probable maximum loss. In between, a row of quiet dials that decide whether your agent can even hit quote. Start with hazard. That's fuel, slope, wind speed, hail frequency, storm surge depth. Then exposure. That's your parcel in inches, not vibes roof type, year built, distance to a hydrant, driveway length, eave overhang, defensible space. Vulnerability converts wood, asphalt, stucco, vents and attachments into curves. How a Class 4 shingle behaves at 80-mile gusts. How embering-proof vents cut intrusion odds. Replacement cost layers labor rates, code upgrades, inflation drift. One wrong number and the whole sheet shifts. Change a dial and the future gets heavier. Turn on climate adjustment and nudge severe e-convective storms up a notch. Set return periods from 1 in 100 to 1 in a 250 and fatten the tail. Tie drought, heat, and wind closer with correlation multipliers so bad years cluster. Link adjacent Z-ops so your ridge inherits a neighbor's burn scar risk. None of that is a headline. It's a checkbox. But when rating agencies police tail risk, those checkboxes become law for underwriters trying to keep an A-. Here's the catch. The sausage is secret. The model code sits behind trade secrets, regulators see filings and exhibits, not source. Anti-redlining rules police outcomes, not the logic inside. So when two blocks with similar loss history see spreads move miles apart across a city line, it reads like nature. It might be a dial. Swap in a vendor roof midge table trained on newer suburbs, and a 1940s grid ages 5 years overnight. Pull a wildfire score from a vendor that never walked your canyon, and a cul-de-sac jumps a tier because lidars saw vegetation density, not irrigated shrubs. AI speeds the triage. Pre-renewal pipelines now ingest aerial imagery, assessor parcels, building footprints, roof condition scores, vegetation index, driveway length, deck attachments, even the shadow of a pine near an eave. The bot assigns a roof score, flags vent types, estimates clearance, then routes files into fast lanes or no appetite. Appeals wait in a queue. The servicer's 30-day clock doesn't. This is how de facto redlining hides in a hazard hoodie. Models lean on proxies roof age, lot size, hydrant distance, driveway length, that correlate with race, income, and older housing stock, without naming them. Urban heat islands packed with 1940s roofs get vulnerability bumps. Hail belts with patchwork shingle histories show loss creep. Coastal fill with shallow utilities shows surge uplift. If mitigation money never reached those blocks, yesterday's gaps become tomorrow's premiums. If an appeal requires a third-party inspection you can't afford, the default stands. Meanwhile, rating agencies lock alignment. To protect capital, carriers must show their 1-1 in. 200 won't blow guardrails when climate drift and correlation stack. That forces portfolios to discipline fewer old roofs, tighter wildfire scores, higher first $1 pain. Reinsurers ask for the same curves at treaty renewal. Sidecar and cat bond investors want mid-high teens returns uncorrelated with equities, which means citizens must clean books before paper sells. Clean on a slide reads as strong underwriting. Clean at your sink reads as no quote. Does mitigation help? Yes, if the model sees it. Proof beats hope. Class 4 roof with invoice and photos. Ember-proof vents documented with a contractor note. Defensible space mapped with dated pics and a tape and frame. Hydrant distance measured, not guessed. Closed permits attached. Without receipts, the pipeline assumes old, risky, and unchanged. With receipts, a junior underwriter can override a roof flag and drop 8% to 15%. Not heroics, paperwork. Microhistory. Two bungalows on the same 1940s block. One replaced a roof last summer, added ember vents, cleared 30 feet. They saved invoices and shot dated photos. The neighbor plans tack. The model ingests aerials, sees dark shingles on both, and a vendor table tags 18 years of roof age. A dry winter bumps the wildfire score. The bot spits a 34% hike with a 2% wind deductible. Family 1 uploads a packet invoice, photos, inspector note. An underwriter removes the roofage penalty and trims 11%. Family 2 misses the appeal window. The servicer force up. Escrow spikes next bill. One more layer. Data errors compound. Third-party records guess roof year, siding, distances, sometimes wrong by a decade. Dispute needs proof assessor pages, permits, invoices, dated images. Ask your agent to push a data correction endorsement. It's boring. It's everything. So what's the fix? Sunlight on the dials and receipts in your file. Model transparency laws face trade secrets. Surplus lines dodge many rate controls. Rating pressure won't ease after rough 2020 seasons. But households can still flip attributes that matter to the box harden where the model looks, then submit a clean packet early. Communities can standardize Class 4 and ember vents, mow hydrants, mark addresses, and certify it annually. Underwriters like disciplined clusters. Appetite reopens a crack where blocks move together. Because the black box isn't one villain. It's layers vendor code, climate drift, rating math, and capital that prefers cushions over nuance. If you don't feed it facts, it feeds on defaults. If you do, you can move a dial the bot already uses. Force-placed insurance. The hidden foreclosure lever. Coverage drops. Lenders don't wait. Here's the lever. It starts as a routine letter, .co, we don't have proof of hazard insurance. Your mortgage has one hard rule, keep continuous coverage. If you don't, the servicer may place it at your expense. That's the whole game. Pricing first. Because this is where budgets snap. Lender placed, also called force placed, typically runs 2 to 5 times what a normal homeowner policy costs. And it's thin. It protects the lender's interest in the structure, not your life inside. Contents? Often no. Liability? Often no. Water backup, matching, ordinance or law? Don't count on it. You don't shop it. You don't pick endorsements. You just pay it or it posts anyway, and your escrow has to catch up. The timeline is faster than you think. Day 1 notice sent. Day 30, if no acceptable proof is on file, the policy is placed and backdated to the lapse date. That means you're billed for days you never chose. Around day 45, escrow analysis runs. The servicer spreads the shortage and the new annual premium across the next 12 months. Your total payment jumps mid-year. Day 60, if you didn't pay the new full amount, the account shows delinquent. Late fees land. Credit can take a hit. Miss again, and default mechanics wake up. Micro moment. A family emails a binder on day 33. The vendor inbox is backed up. The system doesn't see it. LPI posts. Escrow recalcs. Their autopay sends the old total, which the portal treats as partial. A white envelope with bold block type arrives 3 days later. They're technically past due over a data lag. Why does this exist? Servicers answer to investors and bank examiners. The rule is safety and soundness collateral must stay insured. So the machine outsources the gap to you. Retail market failing you isn't an excuse in that rulebook. If admitted and surplus lines won't bind fast enough, the vendor will. There's a quieter money trail. LPI programs pay administrative fees to servicers or affiliates for tracking, placement, and monitoring. Regulators cracked down on the worst practices in the 2010s. Consent orders and all, but the core power stands, no proof. They place it. Vendors get steady premium flow. Servicers stay compliant. The borrower absorbs the shock. Backdating is the knife twist. If your policy lapsed 2 weeks before the letter, the LPI will start there, then bill forward. That back-billed chunk, becomes an escrow shortage that spreads over 12 months, unless you post a lump sum today. A $3,600 advance shows up as $300 extra per month, on top of a higher ongoing premium. That's how a kitchen table budget breaks on a random Tuesday. Now fold in mortgages. ARM's resetting plus an escrow jump is a 1-2 hit. Your debt-to-income ratio looks worse on paper. Right when you need a refi or HELOC to fund the Class 4 roof and ember vents that would lower future quotes. The covenant meant to protect the house ends up blocking the fix. Here's where it links back to the black box. Non-renewals cluster by ZIP. Roof age, access risk. Those clusters create pools of borrowers more likely to hit a forced lapse. Insurance tracking data doesn't just resolve flags. In aggregate, it maps distress. Acquisition teams in single-family rental and note funds buy those maps. Opportunistic isn't a villain word. It's a spreadsheet column. Human beat. A borrower binds a fair plan on day 52. They upload, email, and call. The vendor's service level agreement says 10 business days to process. Meanwhile, November's bill posts with the LPI still on the ledger. They pay principal and interest in full, escrow short, hoping grace covers it. It doesn't. A late fee lands. 2 weeks later, the LPI cancels retro to the fair effective date. A refund drops into escrow. The servicer recalculates again. The family breathes. It took 5 calls, 3 uploads, and a complaint to the state. So, counterplay. Speed is oxygen. Ask your agent for a binder with exact effective dates. Upload it and email it the same day. Call and get a ticket number. If retail won't bind, apply to your state's fair plan immediately. A pending receipt can pause placement if you push. If LPI hits anyway, do not skip the new full payment blindly. Turn off total due autopay while it settles. Pay principal and interest on time. Pay as much escrow as you can. Then, when real coverage binds, demand cancellation retro to the start and a full escrow refund. Put it in writing. If the vendor stalls, file a complaint with your state insurance department and the CFPB portal. Paper moves what phone calls can't. Fix the file. The model penalized roof age and vents it couldn't see. LPI punishes proof it didn't get. Title your PDA FAF, proof _of insurance _. Train crews, Dakostrabave _. Nang unbe scratch. On lawsuits. Deco dequans. Attach the binder, declarations, and a short cover line with loan number, property address, effective dates. Keep every ticket ID. One last truth. LPI isn't a glitch. It's a floor that keeps collateral insured and investor cash flows smooth when consumer markets wobble. From 30,000 feet, that's stability. Keep at your sink. It's a lever that can pry equity loose in 60 days. If you treat it like junk mail, it wins. Who's buying your risk? If you treat it like a court policy to property, keep your house. Follow the letter's data trail. It doesn't stop at your mailbox. It moves upstream, gets cleaned, scored, and comes back down as a buy list. The players aren't hiding. They're the same names shaping insurance appetite at the top of the stack. Apollo with Athene, KKR with Global Atlantic, Blackstone managing giant life blocks and mandates. Harvard called it permanent capital meets private markets. The IMF flagged concentration. In plain English, tend you. The people who price your risk also finance the buyers who can carry it. Start with what the systems actually see. Non-renewal clusters by ZIP. Roof wage flags. Lender-replaced insurance counts and timing. Fair plan applications by month. Delinquency nibbles right after escrow jumps. None of that is a family story. It's columns. When those columns stack, they mark neighborhoods where owner budgets stretch, lender clocks tick, and listings are more likely to read as is. Now look at the buyer. Single-family rental operators don't need your one-policy solution. They buy insurance at scale master programs with higher deductibles and strict exclusions they can manage. They spread wind and hail volatility across thousands of doors. They pair base coverage with parametric riders that pay fast on wind speed or quake magnitude, not after months of adjuster fights. What would crush a household's cash flow becomes portfolio noise inside a fund. Micro-emolment. A servicer's vendor flags a spike in lender, placed across two suburban zips on a wildfire edge. An SFR analyst layers that map over MLS price cuts, roof permits, and days to close trends. The overlap becomes a list of houses more likely to need a quick exit. The buyer calls agents with one script cash. Short inspection, as is, close in 14 days. It lands because the seller is staring at $1,100 escrow jump and a letter that says 30 days. Here's the upstream echo. The same capital building insurance and reinsurance platforms need steady assets to hold mortgages, rental homes, credit. Insurance data feeds where those assets are safest to buy cheap and hold long. Nobody needs a secret meeting. It's all incentives. Tighten appetite in fragile zips. Keep collateral insured with lender-emplaced floors. Watch distress appear. Step in with patient cash. Self-insurance finishes the loop. A landlord will eat a $100,000 cat deductible once every few years and be fine. A family with a 2% wind deductible on a $500,000 insured value won't. 9 or 10 grand cash before help arrives is a budget crater. So the platform writes terms a household can't, funds repairs at bulk rates, and resets rent to carry the risk over time. Same wind, different balance sheet. Is this just climate? Hazard is real. But watch timing tells that don't track weather. Reinsurance renewals hit January 1 or mid-year. Model vendors ship new versions. Appetite screens shift within weeks. Letters bunch by algorithm, not by storm. 3 months later, price cut listings rise in the same pockets. That's policy turning into property. One more scene. A 1970s cul-de-sac in a hail belt. Renewal quotes land with 2% wind/hail deductibles and roof ACV riders. 4 owners can't float a roof this year. One misses proof during a job change. Lender placed hits. The payment jumps mid-ice cycle. An acquisitions rep walks the block at dusk, knocks softly, and leaves a card. No pressure, they say. Just options before the clock gets loud. 30 days later, a deed moves to an LLC tied to an SFR platform. The sign never says the parent name you know. The insurance sits on a master policy you'll never read. Why this works comes down to floors and funnels. Force-placed insurance is a floor under collateral coverage. It protects the note and keeps loss funding predictable for investors even when retail breaks. That predictability is yield. Yield attracts permanent capital. Permanent capital wants more places to park itself. Rental homes make sense when mortgage rates cool, or when families trapped by escrow spikes need out. The funnel is the data risk scores, non-renewals, LPI waves, and quick-close flags flowing from policy desks to property desks. Does anyone collude? You don't need a conspiracy when spreadsheets rhyme. A model pushes tail risk higher. A rating guardrail narrows appetite. A servicer enforces a covenant on a 30-day timer. A buyer armed with patient cash and cheap scale insurance offers relief that fits their numbers. Every step looks rational alone. Together, it moves ownership. So what do you do with that? Map the end buyer like you map the carrier. If SFRs are active in your zip, assume quick offers arrive right after insurance shocks. Decide now what number would make you sell, and what cash you'll keep on hand to ride a spike. If staying is the plan, build the boring moats funds can't copy documented Class 4 roof, ember vents, defensible space. Ordinance or a law bumped to 25% or 50%. ALE tall enough to survive contractor delays. Bind a fire backstop fast if you need to pause a lender-emplaced clock. Keep a dedicated deductible fund so a 2% clause isn't a sale. Because someone will buy your risk if you can't carry it. Today, that someone likely buys it with money that also priced the letter you're holding. The climate alibi versus incentive math. They'll say it's the weather. And yes, hazard is up. Fires burn hotter in the 2020s. Hail bands widened. Flood maps changed. Nobody honest denies that. But here's the rub. Climate is the backdrop. Incentives write the script. When reinsurance gets pricier and rating guardrails tighten, someone chooses which lever to pull. Grants or exclusions, mitigation or non-renewals. Lower deductibles paired with upgrades or percentage deductibles that shift first $1 paying to you. Over and over, the system picked the lever that protects spread first. Start with timing tells. Reinsurance treaties reset January 1 or mid-year. Model vendors push new versions. Within weeks, appetite screens flip across whole ZIFs. Your roof didn't age 5 years in March. A checkbox moved. If it were purely weather, the gradient would look like fuel maps, not filing calendars. Now watch adjacent zips. Same ridge, same fuel, same hydrant distances. One code says no, the next says maybe. That isn't a fire marching a mile. That's a portfolio optimizer keeping a 1 in 200 loss under a rating threshold. Climate explains why the baseline rose. Incentives explain why the edges got cut first and fastest. Deductibles tell the truth in plain numbers. A 2% wind deductible on $500,000 is 10 grand cash before a dollar pays. Most families don't have that. Platforms do. Self-insured landlords spread deductibles across thousands of doors, buy master programs, and use parametric covers that pay on wind speed or quake magnitude. Same storm, different wallet. Incentives reward terms households can't carry and funds can. Force-placed insurance is the loudest quiet proof. If retail quotes are unaffordable, the servicer doesn't freeze your cost and call a task force. They place a policy at 2 to 5 times retail, backdate it, and roll the shortage into escrow. That isn't climate. That's a rule that guarantees cash shows up upstream on time. Investors love floors. Floors stabilize returns. Your budget eats the shock. Models wear the alibi well. RMS and AIR add climate adjustments, fatter tails, tighter correlations. Sensible for solvency. But those dials live behind trade secrets. Regulators see filings, not code. Anti-redlining laws police outcomes, not math. So proxies roof age, hydrant distance, lot size, map to older housing and lower incomes without saying so. If mitigation dollars never reach those blocks, yesterday's disrepair becomes tomorrow's surcharge. That's not a storm. That's history priced forward. Permanent capital sharpened the tilt. In the 2020s, Apollo merged with Athene. KKR bought Global Atlantic. Blackstone managed life blocks and mandates. Harvard called it permanent capital meets private markets. The IMF flagged concentration. These platforms love predictable spread. They hold both sides of the pipe liabilities in insurance, assets and credit, and housing. When a model says a tail fattens, appetite moves. When a letter lands, a buyer with patient cash and scale insurance stands nearby. No conspiracy. Look for the 3 beats that repeat: treaties reprice, models update, appetite shrinks. Months later, non-renewals bunch. 30-day clocks start. Escrow spikes. Listings go as is. Cash closes fast. If it were only climate, you wouldn't see the cadence. You'd see chaos. Instead, you see cycles with calendar teeth.